Section 2 of Topic 2 of Paper 8 deals with the secondary market. So Section 1 looked at the primary market, where shares are put into the market for the initial investors to buy. Secondary market is the stock exchange, where we've got the listed securities traded among investors, and market liquidity is extremely important for the secondary market. The market liquidity supports the primary market, and the volume of shares available in the secondary market is supported by the primary market. Okay, 2.2, the trading system. Some administrative details there on the timing of the market. The trading platform that Hong Kong uses is the Orion trading platform, and that has been operating since 2018, and it's only accessible to exchange participants. That's a very important point, and we will return to the exchange participants' role in trading on the stock exchange in Section 5. Liquidity of a market is the ability of investors to buy and sell, and if a security can only be bought at an unreasonable price, too high, too low, it may be that the market is not considered liquid. Now, bid offer prices. We've got 3 bullet points here covering narrative on bid offer prices, but the exam will often introduce numbers, illustrations, and get you to answer accordingly. So while we've got no numbers in these lecture notes, the practice questions do cover some of the question types that you're going to see on bid offer prices. Very quickly, the bid price, it's the highest price that a buyer is willing to pay for a security at a particular time. So sometimes this is slightly abstract. If you were looking to buy a property, buy a house, and you're wondering what to pay, well, you're going to put in the price, the highest price you are willing to pay to get it. And that is exactly the same with securities. And the offer, or ask price, that's the lowest price at which a seller is willing to sell at a particular time. So with my house analogy, you go in with your highest bid and you hope that it is equal or higher than the lowest price that the seller is going to accept. And that makes it a little bit more real than the abstract situation of securities that you cannot actually see. And then we're told the spread difference between current bid price and the current offer of a security, and the incremental spread is marginal or additional spread between the prices, and that depends on the price of that security. Okay, as I say, you may well be faced with a question that is a lot more numerative than the notes we've provided, and you can cover that by looking at the practice questions. Different types of stock order, and at the bottom of page 10 we list the most common types. The market order, also referred to as unrestricted, that's your instruction to execute the best available price. So if you are selling, you need money, then you go to your broker or exchange participant and just say, it's a market order, just sell, get me the best price. Limit order, you're a little bit more reserved. There you specify the highest, the lowest price that you will accept for a transaction, as well as size, expiry time, date, all the details, the limits on your order. A stop loss order, that's used to limit your loss. So if prices are falling, then you will give a price at which you must sell. Stop gain order, opposite stop loss, enable a gain to be realized. So if prices are going up and you're getting a bit nervous, might be getting a bit too high, might fall in the future, you say if it hits that price, let's seal the gain. Now, discretionary order we've seen examined. Investors rely upon the dealer or broker professional judgment for entering into a particular transaction. The way they can examine this is to give you a scenario and ask you what type of order it is. And we've seen a few times they've been looking for discretionary order. 2.3, corporate actions and raising additional funds. Okay, well, there's a few summary points at the start. Then we get into bonus issue, rights issue, placing an equity warrant. Now, bonus issue is where an issue of new shares is made to existing shareholders, usually in the proportion of their existing holding. It also can be thought of as a capitalization issue, and no money changes hands. So the shareholders don't have to pay for these extra shares. Now, this can come up as a calculation question. So here's an example. Charlie holds 200 shares worth $2 each immediately before a 1-for-4 bonus issue. So that means you will get 1 bonus share for every 4 that you currently hold. Price per share immediately after the bonus issue is shown below. So we have the number of shares before the issue is 200. Value of shares before, well, the $2 gives you 400 Hong Kong dollars. Bonus issue entitlement. We hold 200, we divide by 4, we get an extra 50 shares. So after the bonus issue, the shareholder Charlie will hold 250 shares. Now, no money's changed hands, so they are still worth 400 Hong Kong dollars. 400 Hong Kong dollars divided by 250, the price immediately after the bonus issue theoretically will be $1.60. Now, in actual fact, the market may move and price may change, move away from $1.60, but what we're looking at is the theoretical price. Summarizing the bonus issue there, the net effect is an increase in the number of shares held and a proportionate decrease in share price, effectively diluting the share price or share value, but not diluting your interest. That's quite important. Dilutes the share price, but not your interest. You will still have the same proportion of shares. Rights issue, similar to bonus issue, but you have to pay for the shares, and what you pay will always be below the market price. Otherwise, a rights issue would not fly. We've given you some summary notes on that. And once again, the worked example, top of page 12, similar to the bonus, except that the value of total shares after the issue increases by $50. And you can see that this time $450, because you got $50 in, divided by 250 shares. This time the theoretical price will be $1.80. Now, the subscription price was $1, so you paid $1 for the extra share, and it is worth $1.80 at the end of the process. So what that means is the theoretical value of the rights is 80 cents, the $1.80, the theoretical price minus what you paid for the rights subscription, 80 cents. Now, if the rights are renounceable, back to page 11, just under rights issue, renounceable rights issue allows shareholders to sell their entitlement to subscribe. So you could sell your entitlement to the rights issue for 80 cents per share. Placing, we've seen that earlier in the previous lecture where we place shares with identified shareholders. The last point there, placing can be made with existing shares, which will not raise new capital and therefore will have dilution effect, but it can raise new capital and there would be a dilution effect. An equity warrant is something that would be listed and it gives the holder the right to subscribe for the underlying security. It's a form of an option. And when the warrant is exercised, new shares are issued by the issuer. Okay, so under 2.3, we've got 4 methods of raising additional funds in the secondary market: bonus issue, rights issue, placing, and equity warrant. We will deal with equity warrant in more detail in topic 4. Be ready for a numbers question, either on bonus issue or on rights issue, following the numbers that I reviewed. 2.4, Clearing and Settlement System, CCAS. Now, CCAS is where securities are cleared and settled once you have a matched trade in the Orion trading platform. It moves on to CCAS, and then you will have clearing participants that will liaise with the clearinghouse to settle the trades. Be aware, settlement is T+2. Settlement occurs second business day after the transaction date, and we discuss CCAS, clearing and settlement, in a lot more detail under topic 5. Okay, we've got the last 3 sections to cover in topic 2, market surveillance and its effect on participant behavior. Here we're looking at the SFC's role. Their idea is to raise market standards through effective surveillance. The Enforcement Division is an important entity in this process, and we list the responsibilities of the Enforcement Division. After those points, we're told the SFC and the Stock Exchange have the power to investigate any unusual price movements of listed securities. Be aware of that, has been examined. And then we've a few points that relate to the Stock Exchange's ability to suspend or delist a company, and we give you the reasons for such a delisting. Section 4, keeping the market informed. This is the reports that a listed company has to put forward. So under the listing rules, and this is what some entrepreneurs, founders have found very uncomfortable, all the information they've got to provide. A listed issuer is required to provide following reports to the stock exchange and its shareholders. So this is regular reporting. Directors report, annual accounts, plus copy of the auditors report, interim report, notice of meetings, a listing document and or circular if that is relevant, if you're raising capital, copy of any other announcement required to be submitted to newspapers. Stock Exchange wants that submitted electronically so that they can publish it on their website. As I say, that is regular reporting requirements, and some people find that onerous. Others, they're quite happy. It's a small price to pay for access to capital markets. And the final section under topic 2, we look at exchange participants. Now, if you're a broker and you wish to trade directly with the stock exchange trading system or Orion trading platform, you must become an exchange participant. Once you're an exchange participant, you must apply and then hold at least one stock exchange trading right. So first of all, you become the exchange participant, then you apply and hold a trading right. You are then in a position to trade with the exchange. Those 2 points, a very high chance of being examined. And then we've listed all the charges that you have to pay as an exchange participant. Not examined that regularly. Okay, we're at the end of topic 2. How do I get ready for the exam? As ever, read the material, but it's not a case of memorizing it. You should be going to practice questions, doing those questions, getting them right or wrong. Doesn't really matter. The time you want to get the questions right is in the exam. If you get them wrong, you want to review why you got it wrong, what information you were not aware of, and then take it forward. And as I say, we have many questions listed for paper 8 on Examinator.online.